Okay, so let's get started with the daily takedown here and point out a couple things. So, again, trading in the morning, not always the best idea as far as I've seen from my experience. You can see here NVIDIA has been trading up, now it's down. A lot of times you do get this midday action here, but honestly, the hedge funds, the big guys, they usually wait till the end of the day to trade. So again, you don't need to worry about getting out of bed in the morning, stuff like that. Wait, trading at these early hours, depending on your trading strategy, that might work out well for you. But here we're trying to make you the most money by putting in the least amount of effort or action possible. Again, let's have the market do the work for us. One of the things I want to cover that I didn't dish on last video because I was looking at going back to things like that big Yahoo top gainers and losses. So remember yesterday when I was like, oh man, Google's down 7%. That's kind of unusual. We're going to hit up on that. So first thing I want to check out is the top gainers and losses. Okay, so you see it's up 24%. It's got a movement of $3. Okay. So when the stock is at this low, when it's in the low teens, mid teens, even in the 20s, small movements like that are going to be large percentage gains or losses. But there's also a tendency for those gains to evaporate very quickly. Look no further than like hymns. If we were to take a look at hymns, you can see from, let's see, let's just do a 1 year graph. See how you get these large movements up, then you get a crash. Now we're getting a large movement up. I don't know if this is enough we're not calling this a crash yet, but obviously it could be going down. So, it's trading in the 30s, high 20s, goes all the way up to, I think we're peaking at like $70 or not getting close to $70. Okay, that's a triple in the course of that time. Double and a triple in the course of a couple months. Hey, that gets a little rough to hold, especially when there's not this isn't a Planeteer. This isn't a NVIDIA. This is HIMS. So, when you're looking at these big daily movements, just be cognizant of that if you're going to start trading some of these things. There's nothing, Trade Desk is one that stands out because Trade Desk is a stock that I've been buying and looking at for a while. Let's just take a look at that one a little bit closer because that one's had a big jump today. And what this chart can indicate to you is that obviously something happened that day that is noteworthy. Keep in mind, it doesn't mean that you should sell your stock. Okay. This could be the start of a huge run of it going up. You also need to keep that in mind. Remember, stocks go up by hundreds and thousands of percent, not tens. Just because a stock went up 20% doesn't mean it doesn't have another 20 or 30 or even 40% to go for the rest of the year. Stocks actually do move in that way. And that's why I always tell you, watch a stock for 2 years before you start buying, before you are selling it. You got to just watch it for 2 years so you understand the behaviors of it. It's always a cardinal rule. Going back to this chart though, what you want to do when you see these big jumps of like 18, 19, 20%, start reading the news articles about it. Okay. Performance is improving thanks to demand for AI powered ad buying system. What you want to do is, in addition to your news column where you're looking at the Wall Street Journal, Market Watch, Barron's, is start reading these articles that come up on Apple News especially when you have big days like this. When you have big days like this, you need to be paying attention because this is how you're going to be able to tell if that stock is just beginning a run or if it's a flash in the pan kind of thing. And that's all you need to do is really keep an eye on these things when you see these big movements. If you already own the stock, especially, go and start reading the news articles. What happened to it? Why is it doing that? Are they expecting it to continue? Are there problems down the line? Trade Desk is a leader in their area, so I don't really expect this to decline, to go down really. But this stock overall has a lot of ups and downs. Okay, you can see here, this is the 5 year chart. But even over 5 years, you've got more than a double. Okay. So this is probably in the range of, I don't know, earning at least 25, 28% over that 5 year term. It's not bad. This is a great time to buy it because it's going to go back up here eventually. Okay. It's going to go back up here eventually. This crash was due to just like people cutting advertising budgets, which that's always temporary. You always pick up your advertising eventually. So, this is you already seen, hey, it's starting to rebound. They released an earnings report. Looks like it's going to be good. and it's going to continue on. So this is a stock that you can jump in on right now. It's already had a good run up, but this is the first bounce that you're probably going to have in terms of multiple bounces. Just look at it in the past. Here's the bounce going from 45 up to 74, very similar to what we're just seeing right now. 49 up to 71. Boom. May not stick, but if you hold on to it for longer, boom, boom, boom. And if it goes down here, just buy more. You know, we don't really want to sell. We want to buy more. You want to have convictions in the stocks that you're buying. And Trade Desk is a good company to own. All right. Looking down the rest of this list, there's nothing that's really catching my attention. Once we get into these $6 and $7 or 6 and 7% movements, not too curious about them. I'm looking for the big day ones, the 20s, the 30%, maybe in the teens. Just kind of depends on where we're at or what kind of stock it is. Again, depends on the movement. If a stock usually moves by 1 or 2%, you see it move by 8, maybe you need to start looking at what's going on in the news. I'll go back to the Google example. So for those of you that own Google, I don't know. I'd be getting out of this. That's just me. I'm not saying it's not going to continue to increase in value, but you've got a big problem with Google, and that's really what they laid out in this article. And this is also why the stock dropped 7% the other day. Okay. AI is really eating away at Google's search business, especially with Perplexity and ChatGPT. Me personally, I'm cutting down on my Google usage a lot. I'm using a lot of ChatGPT. I'm going to use a lot of Perplexity. With the partnerships that both ChatGPT and Perplexity are signing up with now, their search engine piece is in trouble. I'm not saying they're going out of business. I'm just saying, hey, this is something to consider because a lot of people are going to start using these AI tools in lieu of Google's search bar. So this is a good article that kind of explains a lot of that if you want to go back and take a look at it. And yes, it's not an end all to be all, but this is something, again, when you see a stock that normally moves by 1 or 2% like Google, if it's moving by 7%, you want to take notice. You want to take notice of it. All right, let's see. I don't see anything here that we want to take a look at. SoundHound is one I've been watching. It's down another 6%, but it's been hovering around $9, $10 for the last couple months. If anything, maybe pick up a couple extra shares because I do see that rebounding. They've got really good tech. So, that's already hit 23, I think. So even just by getting back up to 23, you've got a solid double and change on your hands. And that could happen later on this year. Okay, so time for our, what I would call the major news comb that you always want to do. And what you're doing in your news comb is just looking for general market information and also information about the stocks you already own. Okay. Most of what you're going to see on these websites is just filler. It's not really going to apply to you. You can spend your time reading it if you want. I don't really recommend it because that's a lot of time wasted. Even something like this, okay, China is sending a security guard to begin trade talks with the U.S. Okay, that's a positive thing, but nothing's happened yet. Okay, you got to remember that. Nothing has happened yet. So we're just going to go through these articles real quick and just ignore the ones that we don't need. Again, this opinion side, typically don't need it. If you want to read about the Pope, the new Pope and everything like that, by all means do that. But for me, I stay laser focused on business because I want to cut the time I'm doing my research on the stocks down considerably less than what I need to do. I don't want to spend hours per day doing it. I want to cut it down to about an hour, maybe change. But any of this, so is it sad, but not about business? No, don't care about Russian gas. I actually don't trade in energy at all just because if you're not actively trading oil and gas stocks, you're not really going to make any money in them. If it's a buy and hold strategy that you're looking at, you're just not going to make money in them. You're going to get your dividend, sure. Everybody's going to say that. Well, you get a 4% dividend with such and such stock, or maybe you get a 6 or 7% dividend. That's not 20. you get basically a flat return, in oil and gas companies. Pope. Supreme Court justice dies. Not important. Dividends. Okay. Putin, we're going to ignore that one for now. Dividends. Let's talk about dividends. Okay. Because there's all this. I always love it when people come to me and they're like, well, what about dividend stocks? And should we be looking at those and things like that? In my personal opinion, no. Okay. Dividends got a reputation for being a good investment like in the 1980s. Okay. And that's because stocks didn't do what they do now. Stocks gained by 15, 20, 30% a year. Okay, in the 80s, if you got 8%, that was a great year. If you got 10%, that was a killer year. And part of that was your dividends. And your dividends were also considerably more than they are now. Your average dividend now is like 1, maybe 2%. It's not the end all to be all. It's not the saving grace of what it was. If you want to grow old and live off your dividend income, you need to have a butt ton of money. Okay. Because, even if you have 100 grand and you get a 1% dividend, that's $1,000 a year. It's not getting you anywhere. Okay. So if you want to have $10,000 in dividend income, you have to have a 1% yield. You've got to have $1,000,000 in that stock. If it's a 2% yield, you got to have 500 grand in that 2% stock. So dividends to me aren't, I mean, it's a nice little add-on. It's an appetizer, I guess, but it's not something that I really look for anymore, because you don't have these companies that are paying these great 4 and 5% dividends that also give you growth. Okay, if you got a company that has a good dividend, it might appreciate by 5% a year, and that's a maybe. It may not even do that, to be honest with you. And I'm not saying you don't need to buy dividend stocks. What I'm saying is that you can always buy them later. You can buy them in your 70s. Okay, you need to conserve your portfolio or whatever. You don't need to buy them when you're in 20s, 30s, 40s, 50s, and probably not even in your 60s, to be honest with you. Because even when you retire in your 60s, you're going to live until your 80s or you're in your 90s. You got another 20, 30 years to go. You still want your portfolio to grow. And that's one thing I see a lot of people do. They go too conservative too soon, and you shouldn't do that. It's just going to kill your portfolio returns. Okay, so let's see what this article is going to say just about, because it says this is one of the highest returns that you can get. So let's just see. Again, I do a very fast scroll because I'm looking for numbers, and there's no numbers listed here. So no numbers, no numbers. Here's some numbers, but it's just the S&P. There's no interest rates. There's no yields that are being quoted. This is all filler for the most part. Even this graph is going back to 1930. Okay, give us some more recent data. Give us something that isn't going back 100 years. Let's see. $1,000 investment when made in 1930 would have grown to 8.6 million. Well, yeah, it's 100 years. Okay, fuck yeah, it's gonna grow that. It's definitely gonna grow that. Actually, let's see. It doesn't even tell what the it's making a couple of recommendations on the shareholder yield, but yeah, there's actually nothing in this article that really says what to buy. But let's just take a look at some dividend stocks and I can show you what I mean. So the other day I covered ExxonMobil. That's an important one. Okay, so here's the last 10 years. Okay, so you're basically flat. You've gone from 86 to 107. You're up 22%. But that's over 10 years. So you're at a 2% gain per year. But you get a dividend of 3.73. So like I said, you're at 5-6%, the total return, unless you're trading it. And here you're not really trading anything because the stock really isn't appreciating. From 2015, no appreciation. 2016, no appreciation. 2017, no appreciation. 2019, no appreciation. Then COVID hits, bam. Okay, you could buy it here and you could get a really good dividend yield, and then you could get the run up. But then again, you're not having a ton of gains, and this is going to come back down because I've seen ExxonMobil do this before as well. Let's take a look at J&J, Johnson and Johnson, another big dividend player. Again, the yield was 3.34. 10-year total return is up 51%. So over 10 years, that's less than a 5% return. You can see it's starting to kind of trail off a little bit. Again, dividend yields, let's check. I think McDonald's doesn't have a bad one. So this is very typical for a dividend, 2.26. Now, over a 10-year time frame, that's pretty good actually. Yeah, I'm not gonna lie. Over a 10-year time frame, going from 95 to 311, that's pretty choice. I mean, you got you got a that's a triple from your original investment. That's actually impressive for McDonald's. It's not a stock that I would buy, but this is actually a really good example of a stock that doesn't sacrifice its growth for the dividend yield. So something to consider, but I'm not really into, I'm not going to buy a fast food stock. Definitely not. Okay, so that's my take on dividends. Like I don't really think it's not something I look for when I'm buying a stock. I'm a growth guy. I want momentum. I want 20% per gains per year that I can bank on for the next 10 years. Surprisingly, McDonald's was actually doing that. That's actually still not going to buy it, but that's just impressive. Let's see here. Newscomb. Nope. 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 This is old. Nope. Nope. Don't care about that. Nope. 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 Maybe an interesting article to read, but no, no. That could be an interesting article to read, but it's not exactly about my business, unless I own Berkshire. No, 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 no. Let's see. Why airlines are betting billions on first class and trim economy. Listen, I know that this is a good business because I've been in habits of upgrading my flights a lot lately. Again, I did a whole travel hacking course on it. I'm still not buying an airline. Airline stocks are terrible. Let's take a look at them. Okay, so here's Delta Airlines. 10 years, you're up 1.65%. Not great. Let's take a look at Alaska. I got a client that loves Alaska. 10 years, you're down. Let's check the 5 year. 5 year, you've made a little bit of money. Well, okay, this is a very good example. This is an important lesson right here because you check this 5 year graph and you see that it's a double. You always want to check the timing of it. Okay, the what I call the cutoff range of this graph, because here's what I can tell you. This is right around 2020 when COVID hit. So let's go to the 10 year and I'll show you what I mean. You're looking at the graph as it starts right about here, where it has this huge cliff jump drop off and then this surge afterwards. That accounts for most of the return when you're looking at this 5 year graph. You can see here it's just starting to come up from $25. I see a lot of people get lost, what I call lost in the charts. They don't know this trick that you get to choose your time period where, hey, you can make your graphs look really good if you start them like right about here. This is, it's a 5 year graph, so it's just happens to be that the timing is right with COVID. If it was a couple months earlier, we'd be starting here and we'd actually be, that 5 year graph would be down. If we were in December, let's say this was December of 2024, 5 years later, we would now be down. So always look at the timing of your graph. This is also important when something like a 2008. Okay. If you're like when we got to the year 2018, stock returns looked really, really good because you had this tank in 2008. And if you started your graph at 2009, you get this huge surge and huge run up. But you got to take into account that the stock market fell 49% in 2008. It ended the year down 38% in 2008. So you always want to take that into consideration when you're looking at these graphs. It's like, okay, hey, am I being fooled here? Is this a timing thing where this looks better than what it is? It's always important to look at. Okay, let's also take a look at American Airlines. Let's see. Here's the 10 year in American Airlines. 48. It's now at $11. Never buy an airline. Just don't buy airlines. Okay, let's check the rest of the news. I mentioned yesterday, yeah, it'd be very remarkable if the Fed cut interest rates. They're not going to. It's probably going to be the June meeting if they do. And that's pretty much priced into the market. So the market really isn't going to react to that at all. So no, I don't really do foreign exchange. No, don't care about Boston homeowners. You guys are fine, I'm sure, but I'm not a Boston homeowner. Again, this is old Florida, Boston Celtics, blah, blah, blah. No, no, no. Peloton. Let me make it very clear. Because I had a client that bought Peloton. I told her not to, but she really liked Peloton. Never buy stock in an exercise bike company. Okay. And I'm just saying that because you have to understand the product that your business, your stock is selling. Okay. It's an exercise bike. Just by saying that out loud, you should know not to buy that stock. Would you like to buy stock in an exercise bike company? No, I don't. Let's see. TikTok, again, don't buy foreign stocks. IBM sucks. United Health sucks. And I think these are actually all old articles. Okay, so never mind. Let's check MarketWatch. See what we got going on here. Let's see. All right, this is just something I'm going to mention just because I've been doing this for a while and I can see where Goldman Sachs is stating this. Let's just take a look at the market as a whole and see what's going on right now. So here's the S&P 500. Let's go back. What's going on in the last couple of years? So here's where we were back in February. Here's our drop where we kind of hit a bear market territory right here. Okay, just short of bear market. It's very normal during a bear market to see these pumps after it. I'll call them pumps because if we drop afterward, this is what we call a dead cat bounce. Okay, when the market was here and the market's falling and the dead cat bounces a little bit. Depending on how the summer goes, this dead cat's gonna fall again, and it could fall 20% because we regained most of what we've lost. Not all of it from our last high, but we regained most of what we lost. So when Goldman says, "Hey, we could drop another 20% from where we're at," they're not too far off. Let's take a look at this one here because this is again about dividend stocks. That's a video. We're not going to watch that. Cannabis sector. Listen, I'm a big fan of it, but here's the thing. One, this is an opinion article, so you should probably disregard it anyway. But there's not enough regulation for any one company in the cannabis industry to begin making large amounts of profits consecutively and consistently. Okay, it's broken up into too many different areas because of the political boundaries, geographics, demographics. The feds haven't fully approved weed and everything like that. So it's not an investment to me. It can be, weed stocks can be something you trade, but for as far as the buy and hold strategy where you just want to set it and forget it, not recommended at this point. Yeah, let's see. Early signs consumers are starting to pull back on spending. Yeah, you're kind of seeing that everywhere. That's obvious. This is something that I would look at. I'd probably go back and read and say, hey, because it's from the Fed. Okay, if it's from the Fed, you probably want to take a look at it. Or if it's something the Fed is saying, you want to take a look at it. And spending is definitely pulling back. And you can see also where we're having problems. We're probably going to have problems with supply and demand issues. Not like the COVID level area, but China stopped shipping goods here. Okay, so you're going to have empty cargo ships arriving in ports, or the ports are just going to be empty for a little while. We're actually already starting to see some of that transitioning. Let's see. No. Opinion article, no. 24-hour stock trading, just following in the footsteps of crypto. Let's see. Bank of America analyst. This is a Bank of America analyst. Not the greatest in my opinion. Again, Bank of America, Citigroup, Wells Fargo, Credit Suisse, and Deutsche Bank. I don't pay attention to those guys. Really, it's Goldman and JP Morgan. Those guys are pretty dialed in. I would highly recommend just sticking with those. Let's see. Again, this is speculation. We don't really know. More talks about trade deals. No. Let's see. No, let's see. Never buy Boeing. We don't buy oil and gas companies. We just don't. Let's see. The rest of this is not really about stocks or business, so we don't really have to worry about it. Again, always check your horoscope for the day. It might give you some insights into whether you should trade something or whether you shouldn't. There have been many, many times in my life where the horoscope told me not to proceed, and I did, and I shouldn't have, and I paid the price. So now I just check it. I advise you doing that as well. Okay, so the last lesson I'm going to cover here is something that Charlie Munger was really going over, which is Charlie Munger, for those of you that don't know, he's the guy that gives Warren Buffett financial advice, or at least he did. I think he died about 2 years ago. Him and Warren Buffett were really close. He was longtime confidant and advisor to Warren Buffett. They ran Berkshire Hathaway together. Charlie Munger was really known for this saying about if you wanted to beat the market or when to buy stocks. More importantly, when to buy more stock of the shares you already own. Okay. And he had a really good rule of thumb, which is very, very easy, which I'm going to show to you right now, which is whenever a stock is trading below its 200-day moving average, that's when you should buy it. So what you need to do here is go to MarketWatch, type in your little stock symbol. I just typed in Apple, and you need to change this period, simple moving average, to 200 days. Okay. And then this is the 200-day moving average, this black line right here. Okay. And you can see here the 200-day moving average for Apple is 226. And the price it's currently trading at is 198. So you're going to be buying it 10% below the 200-day moving average, which is a great deal for values, which is a great value for a stock, especially something like Apple. Let's check a couple other ones. Let's just check NVIDIA, for example. See if NVIDIA is currently moving above or below its 200-day moving average. Again, you come down here, click on edit, change this to 200 days. NVIDIA is still trading below its 200-day moving average. Okay, it's getting close. 200-day moving average is at 124, and you're buying it at 116. So that's not too bad. But I definitely used this before in the past. Like, some people want to know, okay, hey, when should I buy more, when it hits a certain low point or when it's going down? Check the 200-day moving average. That's always a pretty good indicator of at least that you know that you're getting a good deal on it. Okay, is to check that 200-day moving average. All right, last thing we're going to check, Bitcoin. My personal opinion, you need to be in crypto. I don't care how much. It could be a little, it could be a lot. There's $3 trillion in crypto. Okay, it's not going anywhere anytime soon. Crypto survived the 2008 financial crash, and it's a financial instrument. So it's going to be here. Like, it's not going away. Okay. Again, a lot of major banks have a price target of Bitcoin at 1 million per coin by 2030. So I'm going to talk more about some different Bitcoin strategies and how you can invest and play it kind of safe, or you can just go for broke. But what I typically do is I check Bitcoin, Ethereum, and XRP. XRP is also another one that I highly, highly recommend that you start picking up some of. A really good strategy, and I'll talk more about this in another video, is to just buy a few dollars a day. Could be $5, could be $20, could be $30, whatever. But the return on crypto is it's a lot more volatile, but the return on crypto is going to be at 10 times on your money, where a stock is typically going to be a double or a triple or a 5 times on your money. And the stock is going to take longer to pay off. You're probably going to get a 10 times on your money in crypto within 5 to 7 years. Okay. I personally don't really gamble on the meme coins and things like that. I might do that later on. But for Bitcoin, Ethereum, and XRP, specifically XRP and Bitcoin, those are the ones I'm taking a stake in. And you can see here, hey, it's back above 103,000. Get it before it gets to 1 million.